And welcome to Tax Calc TV. As ever, we're on our mission to keep you informed about all of the pressing issues facing the profession this year and every year. This week, we are talking about crypto, and in particular, what you need to know if any of your clients hold any crypto assets. Recent legislation means that crypto transactions are now being automatically reported to HMRC. The number of nudge letters but those with a potential liability is on the increase. And HMRC are employing more and more people with crypto experience. So it does very much seem that this area is very much in the crosshairs of the taxman. So in true Tax Calc fashion, we've assembled what is an incredible panel of experts to help you understand what is going on, what you and your clients need to know, what you can expect in the coming months and years. First of all, we've got Laura Knight and Louise Lane. They're preeminent experts in crypto tax. They're on hand to take your questions on how you can advise your clients and keep them compliant. We're also joined by Dan Howitt. Welcome, Dan. Dan is the founder of Recap, which is a software tool designed to help you keep track of any crypto transactions and optimize the tax position for your clients as well. So we're in very safe hands. We've got a lot to get through today. I hope we won't run over, but there may be a few minutes because there is so much to fit in. So very quickly, some housekeeping. If you're new to Tax Calc TV, you'll know that the bottom right-hand corner is where you want to go. There's three icons of interest. One is the chat. That's for everyone to chat between themselves. So everyone will see what you put in there, so you can put comments for other viewers as well. If you've got a particularly burning question, though, the chat does tend to get very busy. So if you've got a particular question that you'd like us to answer, please use the Q&A or the questions tab. That is only for us. We will only see those. But it does make sure we're more likely to see them. And there's also the polls section. So I am going to start off by running a poll very shortly. But please do keep the questions going throughout. If it's a question that's particularly relevant to what we're speaking about, we'll try and take that question there and then, but otherwise we'll save them all for the very end. So I'm going to start off by posting a poll because we want to know really how you are. The question is, how many clients do you believe currently hold crypto assets today of yours? So I'm going to publish that. The little red dot will appear in the poll section. So how many clients do you believe currently hold crypto assets today? Is it none at all, very few, or all of them? And we'd just like to get an idea of how much exposure you guys may be having already. So very few is the answer, but as we may discover later on, that very few may be an underestimate. But very few people, but one person has said most of them. So that's we'll see how they get on. But most people are saying that they've got very few clients. So let's get started. I said we've got a lot to get through, but why are we talking about this, Dan? Give us the background.
Hi, Andy. Yeah, I think there's two major strands to this, really. One is we just have to address like the industry and the technology of crypto to kind of frame why HMRC are kind of going after it at the moment. So crypto 20 years ago didn't exist, and today it's a $2.2 trillion market. And it's also one of the fastest growing technologies that we've seen. It's kind of faster than the early internet in terms of user adoption growth, also faster than mobile phone adoption growth as well. So we've seen an incredible growth story of effectively an asset class that didn't exist. And today there are almost 500 million users around the world that have and use crypto assets. So it's now become a huge market. Year on year, there's about 14% compound annual growth rate of the market itself. And I think HMRC hit the realization in 2018 that this technology in this industry just isn't going away, which is why they released a new round of guidance in 2018. And since then, they have been investing quite heavily to close the tax gap around crypto. There are some figures that basically came out from the Treasury before they legislated for the crypto asset reporting framework, that there is an estimated 55 to 95% non-compliance when it comes to people filing a crypto return. So there is a huge perceived tax gap out there by HMRC and other tax authorities around the world. And HMRC are putting things in place to close that, CARF being one of them. But the other thing that advisors would have seen this year is the change to the SA 108 on the self-assessment form that now has a specific crypto assets set of boxes.
So what is CARF, Dan? Sorry?
It's the crypto asset reporting framework. So HMRC recognized that they can't close the tax gap alone. They need multi-jurisdictional support to close the tax gap. And CARF basically is a framework at an OECD level where 66 member countries have signed up basically to share taxpayer information. So, for example, if I trade on an exchange in Dubai, on a crypto exchange, that exchange is responsible for reporting that information to the Dubai tax authority, and the Dubai tax authority is then responsible for remitting that back to HMRC. So HMRC is going to have visibility of people's trading activity it actually came into effect in January the 1st, 2026, and they will have the first set of data by May 2027. So we're getting to the point now where, with the self-assessment form changes that they've brought in, they've now got the capability to benchmark what you're filing on your SA 108 against the data they're receiving automatically from the crypto asset reporting framework.
Do you think there's going to be a challenge? I mean, we saw in our poll, most people believe that they've only got very few clients that hold crypto assets. Do you anticipate that a lot of accountants may be surprised how much activity there is that they're perhaps not aware of, that hasn't been made clear to them?
Yes. So if we look at the FCA statistics, they've recently done a survey of crypto adoption in the UK. And it comes out at about 4.5 million people in the UK hold crypto assets. Now, we deal with a lot of accountancy firms that are obviously dealing with clients with crypto assets. And our analytics are that 13% of self-assessment filers have some kind of crypto asset exposure. So potentially way higher than what we're seeing in the poll right now.
And are people generally disclosing appropriately, or are they, I mean, is it something that they don't consider and accidentally leave off of their self-assessment?
I think there's a mixture of a lack of education of what is taxable. Certainly if you're outside of the self-assessment net, if you're just on PAYE, you might not have hit that realization that you need to file a tax return. But I do also think there's a bit of head in the sand as well there. Certainly we've seen that as well.
Well, luckily, we are here to clarify some of those questions about what is taxable, what isn't, and how it's taxable. But the nudge letters that were going out, what have you got to say about that?
So last year there were, I think, 66,000 nudge letters that went out to individuals as a prompt that you might need to file. I think last year was, we've seen it in other years, but I think last year was the point in time where you actually had to respond to HMRC. Is that right?
They did ramp up the severity of the letters. Initially, they said, just make sure you've got everything up to date. But then the later batch said you actually need to contact us. And if there's nothing to declare, we want the evidence to support that. So they definitely harshened their approach.
Yeah. So that's certainly something that's ramping up. Okay. So before we move on, Elaine, and to anyone else who is watching, yes, there will be a recording. I should have made that clear at the beginning. There is lots to be that we sent out in an email, and I'm sure lots of people will want to go over that more often. So let's get into the legal status of crypto. Laura, what are the terms that we need to be aware of?
Well, I think it's worth starting off by saying that there's no such thing as crypto tax. And I'm just as bad as everyone else for using that terminology. But we actually don't have any legislation specifically for crypto assets as it currently stands. So we're required to use existing tax law and then consider transactions and where they fit within first principles approach. So that's where we're at in terms of this sort of crypto tax terminology that you're going to hear, and you'll probably hear it later on. But I just wanted to sort of set that out at the beginning. And then
we've lost half of our audience now. You've just said there's no crypto tax. That, but no.
So I mean, so then we're at, from a legal perspective, it's the case of crypto assets are intangible assets, but they don't always fit within our typical personal property rights as we understand them. And so we haven't got shows in possession, and quite often won't have a shows in action in relation to crypto assets. So it's been reliant on the courts over the years to establish and develop case law around crypto assets and rights. And the cases that have come forward over the years, all the way back since 2018 onwards, have determined that crypto assets are still capable of being personal property, even if they don't fit into our previous terminology. So, but in terms of going forward, what we've ended up with, just to really put it on some kind of sure footing, and I just want to make sure that everyone understands there hadn't been any change in terms of property rights and it's suddenly becoming a thing. We had the Property, Digital Assets, etc. Act 2024 bill come through. And what that does is it's just put a legislative footing saying that crypto assets are capable of being personal property, even if they're not a thing in possession or a thing in action. I think the entire act is probably one of the shortest acts we've ever got. I think it's about 3 lines. And I know there was some confusion.
It has the word etc. in it.
It does have the word etc.
That's fantastic.
Bit lazy.
Yeah, I love that.
But whilst I think there was a bit of noise around it at the time saying, oh, so crypto's now property for tax? Well, actually nothing's changed. And so then it's a case of, so are crypto assets property? And I'll start with, are they property for UK capital gains tax? And the answer is absolutely yes. But we've got the TCGA section 21. It defines an asset as being all forms of property that shall be assets for the purposes of this act, whether situated in the UK or not. And it goes on to provide a list of types of property, but it is not exhaustive. So everything's capable. If it's capable in property, then it's an asset for capital gains tax purposes. One of the subsections is actually incorporeal property. They use the terminology, which is just your intangible assets, including legal rights that can be turned into money or money's worth. And if we take crypto assets as an example, if we've got Bitcoin, we can absolutely receive Bitcoin and swap that for either fiat or for something else that can be swapped for fiat as well. So when we're talking about tax, we are talking about crypto assets are subject to capital gains tax. And that's not a new change. None of the guidance that's been brought in over the years hasn't suddenly changed this. It's just applying the law to these assets.
So does that only come into play when you swap that, or is it only when? How does that work?
Yeah, so in terms of is it an asset, we're looking at, for those purposes, for capital gains tax purposes, so then is it a case of, is it an asset for acquisition and disposal purposes? Louise is going to go into a bit more on how that works later down the line, but it is important because it's subject to capital gains reporting and capital gains tax and capital gains losses as well. And actually there is a number of those in a lot of cases that we see with clients.
So just a couple of questions. So Maria's asking, so do you only report if you receive income and make a profit, or?
For crypto, well, we'll go to this in more detail later. There's 2 different points here. For capital gains purposes, any transaction, a crypto to crypto swap, is subject to capital gains tax. It's a disposal of the asset. If you do anything with your crypto asset and you receive something else, that's a taxable disposal and needs reporting. Income is different because we're going to be looking at, this trading versus investment is one part of it. But we also do have crypto asset income, so income that is received in crypto asset form. For employment tax purposes, if it's money or money's worth, we have to consider that, and the time of receipt is applicable for that, paying tax on that as employment income. And then we also have other types of income, such as yield that you might get on some of your crypto asset income. And again, that's reported on your tax return, subject to limits. And in that scenario, it's having to convert the income, that crypto asset value on the day that you receive it or are able to receive it into GBP, and that is taxable.
I think people will be going through the recording of this quite avidly at the end, because there's a lot to take in. But let's just get a look at the size of the market, Dan. You were going to explain sort of how big this is.
Yeah, sure. So I think one thing, just to kind of reiterate some of Laura's points there, is that one thing we can be sure of is that crypto isn't money, right? It's not money. I know Louise will get into this in a second as well. It's certainly not gambling as well. I'll let Louise get into the nitty gritty of that. It's a chargeable asset class. But in terms of crypto lingo, you're going to hear some terms that your clients will be talking about when they're talking about their crypto portfolio and their transactions. You're going to hear terms like private key, which basically means a way of you securing your crypto assets. Public key, which is a way of you identifying where your crypto assets are stored. You're going to hear terminology like wallets, hardware wallet, again, which are just places where you store your crypto. And then you're going to hear things like centralized exchange or decentralized exchange. And Louise will cover a little bit of this in the webinar as well, around decentralized finance. Again, not trying to get too much into the nitty gritty here, but these are the types of terminology that you will hear when you're talking to crypto clients.
Is a wallet like an app or
yes?
So it's a service. Can you give us some examples of the sort of wallets that people might be talking about?
Yes, the most familiar wallets out there will be wallets like Ledger or Trezor. So they're like hardware wallets where people would store their crypto assets in self-custody, and they would have complete control over those assets. There's no kind of middleman or broker that controls the assets there.
So that's the equivalent of you holding cash?
Yes, essentially. Yeah,
right.
And it's probably the most secure way to hold your crypto assets as well. But yeah, just in terms of size of the market, Andy, 500 million crypto users around the world, 4.5 million in the UK. Total cryptocurrency market cap at the minute is $2.2 trillion. Our analytics at Recap is that 13% of self-assessment filers have some kind of crypto asset exposure. And the average kind of user at Recap has about 2,500 transactions in their crypto portfolio, and they trade on 4 or more cryptocurrency exchange accounts.
Right. So it can be very complicated. Is it Mary, I think, has made that point in the chat that you get a crypto report from a client and it's very hard to decipher. There's so much going on. But I think you may have something coming up to help explain how you can do that more easily, perhaps, Dan, I think.
We cover that a little bit later on, yeah.
We'll definitely be coming on to that. So, Laura, regulatory landscape. Do you want to give us a rundown of who is looking at this and how?
Right. So there are factors at play here. So in terms of the regulatory market, when we're thinking about that,
well, your sound's a little. I don't know if it was just your hair was getting stuck in the mic there. Sorry.
Can everybody hear me? Okay.
That's better. That's much better.
Brilliant. So yeah, in terms of the regulatory side. The FCA have responsibility for regulating this market. Now, what we've had is that, there's we heard this terminology wanting to be the UK be the global crypto hub, and it was a sort of narrative from some years ago. We've had a sort of resurgence of that over the last year or so, because we have been slow in the UK to regulate these assets. And so there have been a number of firms that have gone offshore, sort of favouring regulation and clarity in other jurisdictions. But the FCA have now pushed on with a roadmap that they've got. It's a new regime for crypto asset regulation. The plans for implementation in 2027. There's been a raft of consultations out now that the lawyers are involved in terms of responding to try and focus on regulation in the UK and try and encourage business in the UK. One of the big focuses has been around stable coins, and a stable coin is a token where it's either backed by fiat or pegged to fiat, just for anybody that doesn't know. And
can you give us an example, just in case we might hear some?
So you'll see quite often people have either USDC, so that's Circle, and that USDC, you have like one USDC represents $1 USD. And there's been a big focus on that in the UK as well, and actually globally on that, to try and get some regulation around that in the UK. And all this talk about regulation, and it's been quite frustrating on the tax side because they haven't spoken about tax and accounting. And if they're trying to get businesses to be operating in stable coins, every time that you move in and out of a stable coin, that's creating some kind of tax event at the moment because we haven't applied existing law. So one thing a number of us have all been doing is trying to lobby and say, just don't forget about tax. You can push all this regulation, but don't forget about tax, because ultimately that's going to drive this growth figure and people using these assets. So that's where we are in terms of the FCA. That's all sort of moving forward, but at a slow pace. There have been some changes around exchange traded notes that people might have seen in the news recently. And these are where people can access Bitcoin and other crypto assets through exchange traded notes. And these were available for pension schemes and ISAs up to 2021, but then these got stopped and they were paused, and nothing's really happened until October this year. And there was a notice that going forward from 6th of April 26, exchange traded notes were going to be able to be part of innovative finance ISAs. And they're a specific bunch of ISAs, but the problem about it is it all sounded great. Oh, cool! We're going to open this up now, and actually you can have some access to the underlying assets through ISAs. But actually, no one's offering the ability to obtain ETNs through these specific ISAs. So it's kind of a bit pointless as it currently stands, and there's a lot of backlash about it. There's also a lot of pushback to also have ETFs as well. So you've got these exchange traded funds, huge values, and at the moment they're not capable of being part of ISAs and pension schemes in the UK. The only good thing that did come out of that was that there was confirmation that if you do have a pension scheme or ISA that held these ETNs, you're not going to be required to have to sell them. You can carry on holding them. So that's where we got to in terms of ETNs. And then the other 2 points to consider really, what else have we got to think about? There's accounting standards. There's no specific standard for crypto assets. So it's applying existing accounting standards to the transactions. It's being flagged in terms of an issue, whether we see any changes going forward. It's a bit like with the tax. The accounting and the tax seems to be quite slow behind the regulation. And then we have the tax position. Now, as I said, we don't have any tax legislation specifically for crypto assets. We do have HMRC guidance. It started, we had the first published document was in 2014. It was a sort of 1 or 2 pager. And it did cause some controversy over the years because there was a wording in there that talks about capital gains. And then it goes on to say a transaction may be so highly speculative that it is not taxable. or any losses relievable. For example, gambling or betting wins are not taxable, and gambling losses cannot be offset against other profits. And this led to this kind of misconception that actually crypto assets, being highly speculative, could be treated as gambling and therefore not taxable. But that isn't the case, and that wasn't necessarily the intention, but it's the bit that caused an issue for a number of years. So then we ended up with this point around gambling. Crypto is gambling, and you'll have heard about this a lot. Now, whilst crypto can be gambling in some circumstances, there is actually, at the moment, there are prediction markets like Pony Market that operate quite like a Betfair exchange with peer-to-peer bets, so you can bet against each other, where you use crypto assets. Well, then we're talking about gambling then potentially. But generally, any kind of crypto asset swaps are not going to be gambling, and that is something that is a big issue that HMRC have had to deal with over the years as well. And then we've had, as Dan was saying earlier, there has been guidance. December 2018 was the first proper policy paper. It provided some detailed guidance on the taxation of crypto assets. And I think the UK were quite ahead in terms of trying to get something out on that. But then it's been slow sort of since in terms of what we've had. We had an update on CITUS the following year. For those who are sort of looking at this, this is a big issue at the moment for clients who might be using foreign income and gains relief, because CITUS, for HMRC guidance perspective, is talking about HMRC's position is it's where the beneficial owner resides and is tax resident. And this has been a bit controversial. So there are other positions, for example, STEP, take an alternative view on it, that actually CITUS should be where the participant who controls a private key is located, for example. So nothing has come to court yet on this, and we're going to be waiting I think everyone's waiting for this test case at some point to see if it's going to actually determine CITUS, because as it stands, there's no specific legislation on it.
Would you mind just very quickly explaining, if you can, if it's possible to explain this very quickly, about what you say about where it's the owner or versus the person who controls the private key? I'm not sure I follow that.
Okay, so for example, if you have an account with an exchange overseas, and assuming that they have a place that's domiciled overseas, this exchange, the way it would operate is you'd set up an account, and that exchange would then acquire those assets, and they would hold the private keys. Quite often, they'll be responsible for it, and actually you can just access those assets through an account.
So it's almost having a broker.
Yeah, in that kind of scenario. But this is really unfortunate for something like foreign income and gains relief. This has been brought in the residence-based tax system to encourage people to come here and be able to have this 4 years tax-free. And shares and securities that are overseas are able to be tax relieved on gains in the UK for the first 4 years. But crypto assets are not, because of this HMRC guidance position, if you're taking that view. So it is a key issue. It's something that is going to change over time potentially, and the Law Commission set out consultation last year for private client law aspect of CITUS to look at this specifically, not for tax purposes, but to look at the legal side of it. But off the back of that, we may see case law that then does change HMRC's guidance on this, but it's waiting for case law to find out.
Okay, so thank you for that, Louise. You were going to give us a run through from a tax perspective. How are we viewing crypto?
Yeah, so Laura sort of touched on it slightly. The first most important point that we rule out is it's probably not going to be gambling. Certainly, the buying and selling of crypto is not considered gambling under any circumstances in HMRC's eyes. There are limited circumstances where there may be genuinely gambling activity in crypto, but that's very different. The point is that Laura was making, there's no specific tax legislation. So we do have to determine the different types of crypto activity that an individual or a company is carrying out, and then decide where that fits in the existing tax law. So the first thing we need to decide with the buying and selling of crypto is, are they doing it to such an extent that they're actually considered as a trader? So if you think about a share day trader, buying and selling stocks and shares at a high frequency, over the years, we've seen a lot of cases go to the courts on these share day trading cases. And what they've established is that there's a very high bar to get over to be considered a trader for the purpose of buying and selling shares. And we believe that's entirely applicable to crypto as well. So the point with the share day trading cases was they were making lots of losses from their day trading. And rather than having a capital loss, they were hoping to have an income tax loss that they could offset against their employment income. So throughout the whole of the cases, HMRC were battling them and saying, no, doesn't matter how often you were trading, how organised and sophisticated it was, this isn't a trading activity. So because of that, it sets such a high bar. In Recap's resources, we've got a really good comprehensive tax guide where we've got an investor versus trader section. It's about 4 or 5 pages looking at the cases, looking at the various factors that HMRC would consider. So what I would say is if you do have a case where you're thinking, is this a bit much? Are they doing a lot? Does it feel a lot more organised than a normal buying and selling investment situation? Then do look at the factors and consider it on its merit. But it's probably not trading, and it probably is CGT for the buying and selling.
And it's subjective and entirely down to you would have to take up each case with HMRC.
Yeah, I've only seen a couple of cases where I think, no, actually, that is trading. The few cases I would consider are if someone has created their own proprietary bot, algorithm, software program, so they're a developer themselves, and they've created a program that's making profits in an automated fashion from arbitrage, sort of tiny differences in prices in the market. So they might go to Binance and buy a token at one price, and then they might go to another platform and buy and sell it for a fractionally different price. But because they can do it in an automated trading fashion, they can make tiny micro profits, and that accumulates. So if they're creating, you can buy these off-the-shelf bots that do that, and I don't think that is necessarily trading. But if you create your own bot to do this, then maybe. Also, and the only other situation would be, let's say you've got a warehouse that you need to rent to house loads and loads of hardware to do some mining activity. So instead of just having a bit of hardware in your house and doing it as a bit of a hobby, you're going large scale. You've got a big warehouse, you're renting it out, you need employees to maintain and keep on top of the equipment, then maybe this is looking more like a trading activity than investment. But yeah, so I think the point is a lot of clients are worried about whether it's trading and therefore self-employment and so all the profits and losses will be subject to income tax and national insurance, and that is a concern for clients. But in most cases, we can reassure them and say, no, look, this is investment for sure, which puts you in a much better position generally.
So, I mean, the concept of mining, I'll not lie to you, I don't understand. It seems to be effectively looking for prime numbers. That's all I can really gather from it. But does that, what kind of questions should an accountant be asking their client about, are you mining? Are you trading? How does that interaction play out?
I mean, I think that is the crux of it. Like, just because finding out that someone has crypto activity is just the tip of the iceberg. That doesn't tell you anywhere near enough. You need to understand what transactions they've undertaken. We have a great big fact find, Laura will have the same, where we want to know how they're using the crypto assets, what kind of activity they're doing. Are they generating income? How are they generating it? What activities are they doing to generate it? And if they mention they're mining, then we've got a whole host of other questions like what hardware are you using and try or what costs are you incurring, and trying to determine if they're allowable or not allowable. So there are loads of sort of points you can drill into once you have a basic understanding of what kind of activity they're doing.
I mean, if you do uncover that one of your clients is kind of heavily involved in this, is it best to get specialist help? Or, I mean, how complex is this going to get, and is it likely to require a whole new chargeable service line? I mean, what are you seeing people do?
I have a huge spectrum of clients. I have some clients that are so simple, you know, they're literally just buying and selling a few crypto assets on 1 or 2 exchanges. They're using software like Recap. It's processing the transactions really well. It's producing a report telling me what the income, the gains are. And that's really simple to deal with. But then you can have the exact opposite end of the spectrum, and it can be incredibly complex. So as much as I don't want to say it depends, it really does depend. We do a real fact find to establish the nature of the transactions. We want to see the data. We'll never give a client a quote without seeing the data. We want to see the data, like be shared into the software they're using. We ask them a whole host of other questions to try and understand the data, because seeing the data alone doesn't help you understand the activity they've been doing and the intent behind it and the context to help with the tax classifications. But I don't want to scare people off, because it doesn't need to be scary and it doesn't need to be complex. By their very nature, we're seeing the more complex cases, aren't we, Laura? I would say.
Yeah, I'd agree with everything that Louise has just said. And we have a real cross range. We have some very simple cases that are easy to deal with, and some very difficult ones. And I'd say the other thing is we have a number of clients that we deal with where we just do this tax aspect just for the client, and they retain their advisor, and we work with the advisor to cover off the complex bit. So where it's just got too much for them, we can then sort of take this piece of the work off them without them having to lose the client. And where Louise says, one of the things here is this is just another asset subject to all the normal taxes that we're used to. The tax points themselves, we know, for CGT disposal on the dates, we know what these look like. We know what to do for all of this stuff generally as advisors. But sometimes it's around the data stuff, and it's how do we reconcile and go through with the data. And quite often when clients come to us in the first instance, it's multiple years as well, because to understand for capital gains tax purposes, we've got to do section 104 pooling and 30-day matching, same day matching. And so we're going right back to the beginning to determine those things. So it might be that we do multiple years in that first catch up, and then advisors then carry on and take it on themselves, or the individual themselves.
And so just taking a couple of questions from the chat here. So Joanne's saying she's seeing a lot of small scale buying through Revolut, the banking app, and it produces a tax P&L for gains, etc. Would that be sufficient for self-assessment reporting, just to be able to pull from that?
Not if it's a P&L report, no. So if the client's trading on just Revolut, and they can get a statement of each acquisition and disposal, then it's going to be enough. But if they're trading on more platforms, we obviously have section 104 pooling, and we need to basically pull in all of the transactions from everywhere they're trading.
So if they're only doing it on Revolut, potentially, but the chances are they're not.
Yeah, I find Revolut data really bad though.
Really?
Yeah, it doesn't give you enough information to work out what asset's been swapped for what. It'll say like a disposal of Bitcoin. It would say how much Bitcoin was disposed, or the value you received in exchange. It's like you have to get the client to get a screenshot of the actual transaction and manually recreate the records. Right. Yeah.
Okay. I think there's going to be a lot.
Shall I carry on with my bit? Yeah.
Yes, please.
So it's not gambling. It's probably not self-employment, the buying and the selling of the crypto. So then you're down to the buying and the selling is going to fall into capital gains tax. It's investment activity. I'll come on in a little bit to where the tax points are. When is there a disposal of that crypto to know that we need to work out the capital gains on it? Then we need to think about income. So we have clients that receive employment income, self-employment income in crypto, and they don't always realise that that's taxable income, and it's just the same as receiving their income in GBP or US dollars. It's exactly the same. We just have to work out the tax point. When is that income receivable? Convert it to GBP at the date it's receivable, and then record that as the self-employed income for the year, or the employment income. I think a really important point to be wary of is we get a lot of clients coming to us who believe they're working in a self-employed capacity for clients in the Web3 space. They're getting paid in crypto, and the danger is if the client they work for is wholly overseas, so no presence in the UK, if it turns out that that employment relationship is actually a deemed tax employment relationship under the IR35 off payroll worker rules, so just the plain status test of are you actually self-employed or are you more like an employee for tax purposes? If you fall to be a deemed employee for tax purposes, then the individual employee is responsible for operating the pay-as-you-earn scheme under a direct pay-as-you-earn scheme rather than the employer. So if you have a client who's self-employed and the client has no presence in the UK, make sure you check that status position and make sure they shouldn't be declaring under pay-as-you-earn themselves. That often gets missed, I would say. So other possible income you could have from crypto is, Dan kind of briefly mentioned DeFi. Decentralized finance is like everything you can do in the traditional world, you can also do in the crypto world, and people do. So staking, for example, if you've heard of that, you lock your tokens up. This is like basic level. I'm sure Dan's cringing at the technological difference between. In my mind, this is for staking. You lock your tokens up for a certain period of time usually, and then at the end of the staking period, you'll get your tokens back, and then you'll get some kind of interest. Now, it's not interest, even if it's called interest. It's never interest, and it's not taxed as interest, but it's some kind of reward, return, etc., compensation for them having your tokens. And
is it not interest, just terminology, not interest? Because it sounds remarkably like interest. So
HMRC go at lengths to stress exactly why it is not interest. Because can you parrot it, Laura? Is it like interest as a money debt or something? I can't remember exactly.
So because interest is related to money, and crypto assets are not money, those returns then can't be in the form of interest in terms of the terminology.
Right. And it's important because if you get income back from crypto and you're wanting to call it interest because you want to make you want to use the reliefs that come with interest, and we do have clients trying to argue that some of it's interest, but it's not. So if you stake your tokens, if you lend your tokens out, you could get rewards, etc. Or mining, for example. Those are all examples of some kind of income that you're getting from your crypto assets, and that's all treated as miscellaneous income. So the other taxable income box, it would go in on page TR3. So it's subject to income tax at the marginal tax rate, no national insurance, and quite importantly, and this point does get missed by other accountants that we see, where you can claim the trade-in allowance as long as you're eligible. So there's the £1,000 trade-in allowance that's eligible against trading or miscellaneous income. So you've got to be careful if they're self-employed, claiming actual expenses or claiming the trade-in allowance, you can't have it again on your miscellaneous income. But for clients without that, it's nice having that £1,000 tax-free. We've got airdrops that come in crypto. Now, airdrops are effectively a marketing promotional tool. If there's a new project, they might issue a new crypto asset and want to get it out there, get a bit of a buzz about it. And so the tax position, according to HMRC, is if you receive an airdrop that you did nothing in exchange for receiving, so all you did was claim it, then it's not taxable. And we get a lot of clients expecting it to be taxable because it might be valuable, it might be worth 8-10 grand, but as long as you did nothing to receive it, it's not taxable, and then probably has a nil acquisition cost. So when you sell it, you pay capital gains tax on the full value. I think the final thing is inheritance tax. We shouldn't forget about inheritance tax. HMRC have had a campaign recently at the end of last year where they confirmed that what we already know, crypto assets are property for inheritance tax purposes. If you have crypto assets at the date of death, you'll take the market value of that, and that will form part of the estate, subject to inheritance tax. So it has to be reported on the IHT forms. The problem is the volatility. So it might have dropped in value by 80% a week after the date of death, and you're still taxed based on the value at the date of death, because the reliefs we have for land and for shares, where you can take into account subsequent drops, there's no legislation there for crypto. And then also there's issues if it's totally irrecoverable. So if you have no access to the crypto because the person who died didn't sort of pass a trail of how to get it, then is that still taxable? And, you know, is there any relief to claim? Lots of questions there.
So this is if they've got a physical wallet and you don't know where that wallet is, then
if you don't have the private keys or the login details to Coinbase, for example, there's no way to get and retrieve that crypto.
Yeah, so this I think it relates to a point Henry's making here about if one is gifted crypto, is the base cost the day the gift was made or the original value of the cryptocurrency to the donor?
Well, actually, so my next point is the tax points on capital gains tax, and I will cover that. So for the buying and selling of crypto, we need to think about what the tax points are. Most clients understand that if you sell crypto for fiat, so GBP, US dollars, etc., that is a disposal for CGT purposes. Exchanging crypto, more people are starting to get the point now, but a lot still aren't. So when you swap one crypto asset for another, that's a tax point. If you pay for goods or services with crypto, so it might be the tiny transaction fees that are incurred on every crypto transaction, they're usually in crypto, that's a disposal of crypto. If you use it to buy goods or services, you can buy a car with crypto. It's effectively selling the crypto for market value and then using those proceeds to buy the good or service. And then finally, to answer that question, if you give crypto away, it's deemed to be a market value disposal, even if you're receiving nothing at all in exchange for that token. It's a market value disposal. So let's say you give away Bitcoin at a time when it's worth 50 grand, and your acquisition cost, your matched acquisition cost based on the Section 104 pooling and matching rules is £500 because you bought it back in 2014. Then you are creating a huge capital gains tax liability that the donor has to pay, even though they've received nothing for the Bitcoin. The only caveat is it's no gain, no loss, so no tax on a gift to a spouse whilst you're still living with them, etc. Normal spousal gift rules, or if you gift to a qualifying EEA charity, that is not tainted, not a tainted donation. So did I answer that question? I can't quite remember the detail of it.
The question was really just about the that valuation. So if one is gifted a cryptocurrency, is the base cost the day the gift was made or the original value of the cryptocurrency to the donor?
So is it a receipt? If you're receiving the gift of crypto, it's market value.
I think it's
market value. Yeah, if you've received crypto, it's market value at the date of receipt.
Okay.
And finally, we've got one more tax.
Now, Louise.
Sorry, we've got one more tax point. So this was brought in February 22 when the guidance on DeFi came in. If you're staking, lending tokens, if you're adding them as collateral where you're taking a loan in exchange for putting down collateral, or if you're going in and out of liquidity pools, all of this is DeFi activity. And if in any of these activities you're giving up beneficial ownership of the tokens, there is a CGT point. So there is a situation based on the facts of the terms and conditions which you have to examine, that you might stake tokens for 15 years. They're totally locked away. You can't access them. You can't benefit from them in any way, but you could realize a gain on the way in and then another gain on the way out if the tokens have appreciated in value while they're in the staking contract. And we've been working really hard with HMRC to bring in new legislation to alleviate those dry tax charges, but we don't have any new laws yet, and we do have to operate this at the moment. So okay. I think like finally, I think we've kind of already implied how the CGT works, but just to be really clear, exactly the same as stocks and shares. So because they're fungible assets, crypto assets, let's set aside NFTs for now. Because crypto assets are fungible, it means we apply the Section 104 pooling rules, pooling and matching. So for individuals, we're matching with the 30-day forwards, and for companies, we're matching 9 days backwards. And that segues nicely to the next point that Dan's got on crypto companies.
Yes, we do need to get to that, but I just want to give kudos to I think it's Kasia in the chat there for her exploding head emoji. That's wonderful, Kasia. Thank you. What
I'm really sorry, because that was a really, really brief overview.
I think we have had a few requests actually for people. I think what we'd like to be able to do is to collect some of these questions that we haven't been able to get to, some of these points, and create a blog, and we'll be posting that onto the Tax Calc site, so we'll let you know, just to help clarify some of these points. But yeah, so Dan, you wanted to get on to BTCs. Now, what are BTCs?
BTC treasuries. Yeah.
You've got
so
30 seconds to do this.
So one of the trends we're seeing at the moment is it's not just individuals that are buying and selling crypto assets. We're seeing a huge movement at the moment of UK companies basically building out crypto treasuries. The vast majority of the time, it's a Bitcoin treasury that we kind of see, and I think the reason for that is, we're seeing company owners, look at their retained profits. We're in a high tax environment, and they're kind of looking at what they can do with those retained profits. They're going to get taxed if they take it out of salary, dividends. If they throw it into a deposit account, they might get 3% interest on it. And some company owners out there have kind of recognized that there probably is an opportunity to build out a Bitcoin treasury. So we've seen companies that are like IT contractors, e-commerce brands, hotels. We've got a plumber that are building out these Bitcoin treasuries within their traditional business. These are not tech businesses. It can just be a traditional business. So, one of the things we have to do slightly differently when we're calculating the capital gains tax is there are slightly different rules for companies. So what we do at Recap is we will generate balance sheet reports, chargeable gains reports, so accountants out there can then make the adjustments at the end of the financial year and account for those treasuries within their end of year process.
So they're basically just putting their cash reserves into a crypto.
Exactly that. Yeah. So we've seen a financial advisor that's been buying Bitcoin over the last 6 years and building out a Bitcoin treasury. We've got a data center owner that's been building out a Bitcoin treasury. As I mentioned, a plumber as well. This is a trend of people trying to create some outsized returns for themselves in the belief that crypto and digital assets are going to significantly appreciate in value. Whether they will or not, I don't know, but that's certainly their thesis.
Okay, and Louise, you've got some points about the tax. How's that treated? How are HMRC doing that?
Yeah, I was going to say, as well as the treasury piece, like having the retained profits, investing them in crypto, we see clients where actually their individual circumstances are such that it's better to invest their crypto through a company rather than individually. So we have a lot of questions, like a lot of advisory meetings with clients about whether their crypto investments should be personal or should be through a limited company. And there are quite a small set of circumstances that would point you towards a company because of the extra accountancy costs, for example. But certainly if someone's got a very large income and they intend to generate a lot of income from their crypto, then it can be quite a useful tool to filter that through a limited company instead. But yeah, from the tax and accounting for companies can be very complex, but it can be very simple. If you've got the situation that Dan was talking about, where a company is just buying some Bitcoin and holding it and doing absolutely nothing with it, then all we need to do is hold that in the balance sheet as an intangible fixed asset and carry out an impairment review each year to compare the original cost to the market value and make an impairment adjustment as appropriate. It's just like any other client, that if they're doing a lot of transactions and they're complex in nature, a lot of DeFi, then it can make the crypto accounting very complex, because recap will absolutely nail the tax position, tell us what the gains are, the income and the balance sheet position. But what we need to do then is work out the double entry bookkeeping to get that into the accounts. And there can be so many different variations of, like, so many different types of transactions with a different bookkeeping entry needed. So it's examining, filtering down, and it can be a lot of manual processing. But yeah, the basic concept is that the income will be taxed as miscellaneous income or trading, depending on the nature of the activity. Generally, the assets, the buying and the selling, will be an investment activity, so chargeable gains and losses, and held in the balance sheet as intangible fixed assets. There are instances where there are trading companies where they're buying and selling crypto as a trading business, but that's just taxed under normal trading rules. So you kind of, like everything with the individuals, you just follow, you work out the type of activity and then apply normal first principles to work out how it's taxed.
Okay, I'm very conscious of time because we've got about 4 minutes, and I really wanted to touch on some of the stuff, because I think a lot of the questions that we've got are where people's heads exploding and how the hell do I keep track of all those transactions. And Dan, I think you were going to give us the data aggregation problem.
Yes, I think I'm mindful that we've blown a lot of people's minds at the moment. My personal reason for being, and the reason that I created Recap in 2018, is because this is a minefield. So how do we get somebody compliant for tax purposes? There's kind of like a 3-step approach. First is consolidation. So we need to fetch all of their transactions, and this is capital gains tax. So we need every transaction the client has ever made. And what we're trying to do is we're trying to build a single source of truth, right? We need to build a ledger of all of the client's activity. So then we can do things like the capital gains tax rules. We can get valuations where we need valuations. And at the end of the day, what we're aiming for is a report that somebody can put on a self-assessment return. So that's kind of Recap's reason for being, the consolidation piece, the crunching the numbers piece, and then we get you a tax report at the end of the day. Where this can fall apart sometimes, and it was mentioned briefly in the conversation, is the quality of the data. The Revolut example is a classic one. We see a lot of cryptocurrency exchanges that actually can't generate a decent tax report, or even a statement of what the client's done. And we're just a crypto tax calculator. So if you put rubbish data in, you're going to get rubbish data out at the end of the day. So there can be some kind of frustration and manual work required in getting people's tax positions kind of up to a point in time that's accurate. But ongoing, you can often mitigate that by doing the upfront work. I don't know if Louise or Laura, you've got anything else to say on the challenges around compliance?
I agree in terms of that. If I'm being honest, we generally, as an industry, we understand tax points and general principles. The issue quite often for crypto assets is the data itself. As a point forward, one of the things that we've been looking at doing is, we try and get our clients to regularly download their data, provide that information on a regular basis, and get into a good practice of going and fetching CSV files. And you get to hear this term a lot, CSVs. It's just another form of another type of Excel document, really. But understand it and working with those clients to try and help them. It is a lot of hand-holding at the beginning, but actually we learn with the clients and build up our experience around that as well.
I'm just laughing at the hand-holding. I've got one guy, he's an old guy in the Philippines, and every time I ask him the most basic question, he has to wait 2 weeks for his Filipino IT friend to come around and help him. how have you done hundreds of thousands of transactions and made all this money, and you can't even get a CSV from,
Well, I was going to recommend that people trading on exchange, you should trade on exchanges that are based in the UK because they give good tax reports. But then we've seen the example of Revolut from somebody in this chat, so that kind of doesn't work out. But the general principle does just kind of stand. If you can trade on a UK exchange or even an exchange based in the US, you're going to get good tax reports. Elsewhere, it's more of a challenge.
So why would somebody? I mean, if you're trading on multiple, I mean, can you not ask your client just to kind of restrict their trades into one particular, just to simplify and streamline the reporting, just to, like, use a limited number of platforms?
I think when people realize the compliance overhead of maintaining managing their crypto taxes over multiple exchanges, they do generally consolidate and move to simplify their position over time.
So I've seen that.
Yeah, because this is something I think, presumably, as this starts to mature and as we see more and more focus on this from HMRC, accountants are going to start to develop service lines specifically for people with crypto, and they're going to be charging more and putting a lot more focus on that. Have you seen that yet? Have you seen people developing services specifically? I mean, I'm talking about a general accountant saying, okay, if you've got crypto, it's going to cost you 20% more.
I don't know. Like, there's a few specialist firms out there, but we're few and far between, aren't we, Laura?
Yeah, and I'd say it's really difficult. You can't put a fee on it either, because it depends on what the client's done in terms of activity. But we've seen more people engaging with it, and I think CAR, whilst this crypto asset reporting framework, whilst it's got a number of issues, what it has done is brought compliance to the forefront. We've had that, plus the fact you've got on the tax return this crypto asset box. So more accountants and advisors are going to, right, okay, we're going to have to really understand about this a bit more now, because I don't have a choice.
Absolutely. Okay. So we have kind of run out of time. Well, I say kind of run out of time. We have run out of time. So what I'd like to do is, first of all, thank you guys for coming in and sharing your advice. I'd like to thank everyone for watching. I do apologize if your head has exploded. We're not liable for that, I must say. But if that has happened, I do apologize. But what I would like to do is invite, we will go through those questions, and I'll invite the panel here to kind of come back, and we'll create a blog post that we can use to answer some of those questions for you. I would like to just post a quick poll based on if you would be interested in any follow-up. Obviously, TaxCalc and Engager, these guys, we produce tax and accounting software. And if you're not a user of TaxCalc or Engager, please let us know if you'd like to follow up on that and find out how TaxCalc and Engager work together to help you run your firm. But also, if you would like to find out more about Recap from Dan, if you do have clients, and he can get a demo of the Recap system. I would also like to thank all of my team for helping me put this on, and like to alert you to a couple of things. So we are taking our event that we started in November last year called Fusion, which is about celebrating the power of working together. And we are taking that on the road. We're going to be in Manchester, Edinburgh, Birmingham, and London this year. I'm going to post into the chat an invitation to that, so you can register. There are only a limited number of tickets, so please follow that link in there. And in next 2 weeks, on the 18th of March, I will be back, and I will be talking about MTD with the team from MTD Therapy, and you can register that here. We'll be on the eve of MTD, and we'll be doing some last minute preparation and planning to make sure that you don't miss anything or anyone. So those links are in the chat. Laura and Louise, please post your email addresses into the chat if you're happy to do that. If you've got specific questions about crypto, please approach Louise and Laura. But if they're generalist questions, hold your horses. We will produce an overview blog piece within the next couple of weeks. And I urge you all to go and take a little nap now. I think you probably need it. So thank you all, Dan, Laura, and Louise, once again. I really, really appreciate you coming in, helping to kind of explain this very, very complex area of accounting and life. Thank you.
My pleasure, Andy. Cheers.
Thank you.
Bye-bye all.